What's up, builders? This is Raise the Bar Radio, where we talk about building wealth, raising capital, and all in all, raising the bar in your business and your life. This is the No BS podcast for capital raisers, investors, and entrepreneurs who are serious about scaling their business and living life on their own terms. I'm Seth Bradley, securities attorney, real estate investor, and entrepreneur, bringing you world-class strategies from the best in the game. If you're ready to raise more capital, close bigger deals, build a better you, and create true financial freedom, you're in the right place. Let's go. All right, welcome to Raise the Bar, elevated conversations around entrepreneurship, capital raising, and real estate. I'm Seth Bradley, your grateful host. Today's guests are powerhouses in the real estate world. Chris Lopez is a broker, investor, entrepreneur, and host of the Passive Pockets podcast. He sold over $300 million in real estate and built an 8-figure portfolio with more than 20 years in the game. Chris has become the go-to expert for investors who want real, data-driven results. And welcome Richard McGirr, a Fortune 100 software consultant turned venture capitalist, real estate investor, and fund manager. He's the host of the Unlimited Capital podcast on the best ever CRE network and brings a rare blend of global perspective, deep technical expertise, and real estate insight to the table. Both Richard and Chris are co-founders of Property Llama, a cutting-edge analytics platform reshaping how investors manage their portfolio. Friends and clients of mine as well. Hey guys, welcome to the show.
How's it going, Seth? Happy to be here.
Hey, Seth.
What's happening, guys? Great to have you on. Man, let's just kick it off. When people walk up to you on the streets, man, what do you tell them what you do? When they ask you, what do you do? Us as entrepreneurs, we have a hard time with that question because we do a lot of different stuff. What do you guys say?
Richard.
Okay. I usually dance around. I say I sell investments. That's usually what I say. What
That's very opaque, Richard.
Well, it's because normally it's like, oh, I'm a fund of funds manager. Oh, so you own real estate? No. Like, oh, so I invest in a lot of credit. Oh, so you're a lender? No. So it's quite hard to explain what you do as a fund of funds guy.
Sounds like a pretty awkward kickoff to a conversation so far.
Yeah. I mean, I guess I really just try to simplify it. What we do as a business as Property Llama Capital is that, like non-joking mode, is we generally work with active landlords, and I'm not talking about people that own all these apartment buildings and stuff like that. I'm talking about usually people between the ages of, call it 50 and 70, who had a very successful career buying single-family rentals. Now, the thing about single-family rentals is that they were taught and sold that these are good income-producing vehicles. I mean, that's the reason when you ask anybody why do you either own real estate or want to invest in real estate, it's always like, oh, I want income. Now, the fact of the matter is that like single-family homes, even duplexes or anything in the small multifamily categories, these are not actually good income-producing vehicles. In fact, on our platform, which is a real estate portfolio analysis software, so it kind of shows you the health of your portfolio, the cash flow, your equity levels, everything like that. Do you want to take a guess at what the average cash on equity is for a single family home in the system? And we've got about a little over $2 billion of real estate in the system.
We talk about like a percentage, talking about an amount like per month?
Yeah,
like
cash
an
on
amount
cash.
per
Just
property?
call it anything.
Oh, man.
Percent.
Like $100. Oh, sorry. I would say $100 a month in cash flow.
-1%. Yeah, -1%.
I should have said negative. I was thinking it might be below zero.
Yeah. Now, the thing is that they are really good growth equity vehicles. So these people have tons of equity. And that basically what we show them is how they can pivot that equity into better income producing assets. The sad fact of the matter is that these rental properties are obviously not great cash flow producing investments. However, they are excellent growth, and you know what I mean between income and growth investments. So they've been really great at producing huge capital gains, like huge growth in the equity positions for these investors. And the good news is that, like our average avatar, and it's a highly common profile in the system, has like $2 million, $3 million of equity in their portfolio. Like I said, among like maybe 7 or 8 properties, but only like $3,000 in cash flow a month, except we show them how like they can either sell those properties or cash out refi or maybe just invest money from IRAs into like in categories of investments that produce a lot better returns. I mean, or at least a lot more cash flow, I should say, specifically. Because, various asset classes have like these different categories of return of either growth or income. And where we've actually found a lot of success is putting these investors into debt funds, because debt funds are like completely on the other side of the spectrum where they're like pure income vehicles with, basically no capital growth. However, when you go from a return of negative 1% cash on equity to something in the mid-teens, high teens, we often see that even if they sold just one property, they would be like entirely at their cash flow goal or like 3/4 of the way there or something like that. And that fit between our investor avatar of these small landlords and credit markets is something that we really discovered and clicked about, beginning of fourth quarter last year in 2024. And then kind of ever since then, we're just like, that is our thing. It sells like crazy. We've absolutely doubled down on it. I mean, to the point where like we're now a credit shop.
I know a lot about your guys' business already, so I can see now how kind of that full circle comes along. You guys as fund managers, placing investors into the right place and, teaching people how to raise capital. All this is turning in. I can see the whole picture now. I can see the ecosystem. Yeah. Chris, what are you seeing, man? What do people tell you or what do you tell them when they walk up to the street and ask you what you do?
I have a much simpler one. I just help people invest in real estate for cash flow. And I'll tweak it some. Richard explained all the stuff on the back end, like the process. And, I usually slightly tailor if it's, my main demographic is an active real estate investor who a lot of times are considering or moving over to more passive investment, right? That's the journey I followed. And so if I know I'm talking with a real estate investor, I help people turn their equity into cash flow. I'll do slight modifications, but it's real estate and cash flow. To me, those are the anchor words that I want my brand associated with in people's mind. Those are two key words. So I emphasize those two words.
Totally. How do you guys balance that as far as appreciation versus cash flow? I mean, does it depend on who the investor is and kind of like what stage they are in life? How do you go about that? Because I know that, people battle with that, and especially with the way that the real estate market's been the last couple of years, people that didn't have cash flow and were really just depending on that appreciation have gotten themselves into trouble. A lot of these folks that were syndicating, doing things like that, they've went back to getting their W-2 because they haven't been able to sustain themselves. And I've heard that time after time, like, hey, I should have actually focused more on cash flow because I can't pay my bills with appreciation. So where do you guys stand with that?
So, I mean, I'm a fan of being bold in saying we work with this type of person with this type of goal. And that's where we've had the most success. And we work with people who are explicitly seeking cash flow, and we have the best, what we think are some of the best products for those type of people. So I would say that's also like in this capital raising / marketing journey that we've been on in the last 3 years, is that we found that just adding friction at the top of the funnel in your messaging or more directly calling out who you are for and who you are not for has just paid incredible dividends, because that means that we can, not a pun about income, but it just means that we are speaking to exactly the right person. And that I also feel that we're in a big kind of silver tsunami play. We just got an email today, Chris, where someone's like, I am ready to retire, and that means I don't want to manage my rentals. I want more income. I have $500,000 I'd like to place next year. That is exactly who we want and exactly who we speak to. And when we're very clear about who we are for and the problems we are solving, then that means that our message resonates 10 times, 20 times more effectively by just being super clear. Do you want cash flow? We will provide you cash flow. We don't even really talk about tax benefits anymore. We don't there's all these other aspects of real estate. We have just honed in on a single avatar with a single problem.
Totally. Yeah, and I'll tell you what, I mean, just hearing you talk about it, it actually piqued my interest, because I probably fit into that category where I have a couple $1 million in equity in these single-family residential properties that I've just kind of picked up along the way. They've appreciated over time. They cash flow a little bit, not a lot, enough to pay the mortgage and pay all the expenses and stuff. But as far as actually putting money into my pocket, Not a lot. It's just kind of sitting there and waiting for it to appreciate. So, as I get older, it's like, you know what, we need to either 1031 these into bigger properties or, take that capital and invest it into something that has more cash flow.
What would you 1031 into it?
I don't know. I'm kind of in a weird spot right now because I'm like, do I want to 1031 into like a bigger property, like let's say a boutique hotel or something like that, and have to take on all those operational duties? Or am I like to a place in my life right now where I don't want to undertake that and I'd rather get into something a little bit more passive? So I'm still kind of weighing my options there.
A phrase that we heard somewhere and have co-opted is return on hassle and not just ROI. And like, as soon as you're like, I'm going to buy a hotel, I was kind of like,
yeah.
Like to
and you guys know I have a lot on my plate already. Yeah. So adding something complex like that might not be the right move right now.
And I asked that question because that's what a lot, you're what a lot of investors are going through, right? You're equity rich on paper, but it's not high income producing. It's like, all right, when can we flip the switch to income? 1031s just aren't attractive right now for return reasons, interest rates. And then, dude, thinking about buying a boutique hotel, my mind's like, you're buying yourself a job. That's me, right? Just no, thank you. But that's kind of like the whole logic, I went through as an investor, we went through as a company was just, hey, people get into real estate. Cash flow is the main reason people get into real estate, right? That is the number one reason people get into it. And it's follow the money. Where's the cash flow, right? And that's what, led us and led a lot of our investors out there. So, I always like to kind of like, as we talk about trends, hit on some, highlights or opportunities as well. Like, I know you have a lot of like people out there, sponsors, capital raisers, listening to your podcast as well. Like, if people in the business aren't focusing on the mega shift happening of the active to passive, and there's so many parts of that journey, and it's going to be, I don't know, a decade long, lots of money being transferred. Like, it's a huge opportunity. It's going to be like a huge wealth transfer.
Yeah, and also like we see it again and again. Like you're talking about like 70% of our LPs are in this exact same situation. I mean, and actually, I would also tell a funny story about the 1031 thing. So we actually originally developed the platform to like do 1031s. Like that was the whole point. Was like, that was also when cap rates were higher than debt interest rates. But it was like, yeah, go take your 4 cap or your 3 cap. Click the 1031 button, go buy a 5.5 cap with 3.5% debt, and yeah, you would triple your cash flow, like kind of one move. Like that was the original purpose, except the problem is that software was built for a world that no longer exists. It's kind of one of the like really unfortunate things. I mean, I wish we could keep 1031. I've got properties I would like to 1031, but
Yeah, I mean that active to passive to active journey is really interesting. I mean, I'll tell you about my story. I mean, I went from working in a big law firm, making a lot of W-2 income, and I got into the passive side kind of at the same time. I bought like single family residential, so I was kind of doing that rental thing, but then I was doing passive investments into syndications because my clients were doing those things. So it kind of started off passive in my mind, and then I went to like the other side and started on the GP side, raising capital, those sorts of things. And now I'm kind of at the point where I'm like, I kind of want to go back to something a lot more passive because, like you said, less hassle, less time. I can focus on some of the higher upside things like with the startups and things like that. What are you guys seeing with some of your clients and the folks that you talk to? How's that journey look like for them?
A lot of it is... it's a lot of trends going on that just confluence a lot of great trends. Obviously, like a lot of rental properties just aren't cash flowing like they used to. And you just can't squeeze any more out of it unless you're like, all right, let's convert your single family house to like a 9-bedroom room by room rental, right? No one wants to do that, but that's like, you want cash flow, you can do that. And so a lot of people also kind of hitting like, I'll say a next major milestone in their life might be an early retirement, might be kids are off to, all out of the house. They're ready to start traveling, or it's kind of like, a pretty big step for like simplifying their life. And then here, we're in Denver. Something that's kind of local to at least us is Colorado. The last couple of years has passed a lot of laws. I mean, years ago, we were a red state, we were a purple state. Now we're like a blue state when it comes to like just, tenant landlord laws. And so it's just made it like incredibly difficult. A lot of people are like, I don't want to deal with this. And so they're kind of that return hassles. Like, I'm doing all this work, doing all this risk. I want to sell and go passive. So, that's the mindset people are in. But the things they want is they want cash flow and they want to stay in real estate, right? Because that's what they know. And then some people do DSTs, a very small portion. Some are still doing 1031s. I mean, DSTs, I'd say like low single digits. 1031s are low to mid single digits. And then people are either holding or they're selling and paying taxes, and then investing in debt funds, investing in other investments as well. But a lot of people are just liquidating, and they're being smart, right? Hey, they got a 10, 20 unit portfolio, and they might do 1 or 2 a year, right? Based on just, hey, this property numbers I got a lot of equity. It's the dog of the portfolio. Let's just sell it and move on. So, but that's kind of the mindset people are in. And then, it's going to be a multi-year shift that people are transitioning.
Yeah. Richard, do you have something to say there?
Yeah, I mean, it's funny because his comment about what's the dog of your portfolio, that's like our sales script, or not a sales script, that's our portfolio analysis script, is we're like, oh, that's a great portfolio we got here. Like we log in, we're screen sharing, and then like the first question is like, which one of these do you hate? And somebody always has one. They're always like, that one. And we're just like, oh, okay. Why? Well, this and this and this and this and this. Well, what if you sold that and then we went into this debt fund? I mean, it's just like a beautiful straight line kind of conversation.
Yeah. Do you guys think this is a temporary problem, or do you think this is a long-term problem? With the interest rates the way that they are, interest rates will come down at some point. Debt funds, obviously have taken off in the last few years, especially while people were kind of pivoting from typically investing in multifamily, what they know, things like that. Cash flows went way, way down. Deals don't really work. So a lot of people are going to these debt funds because they want that cash flow, and they want to take some risk off the table because they're getting that cash flow from day one. I mean, do you see this as temporary? Or do you think this will stick around?
I think there's two things. Number one, I think you have to take a look at the just insane run that multifamily had, like post Great Financial Crisis. Where you could be in a major city and like literally buy an 8 cap. And then when you also huge amounts of like zero interest rate policy, which A, kept debt rates really low, and then B, caused a lot of rent growth. And that it's like the combination of rent growth and what would this be, like multiple expansion, or cap rate compression. It's funny because those two terms go in opposite directions and mean the same thing. But like, I don't see how structurally we're going to have a repeat of like the massive bull run that we had from like 2010 to like 2021. And that kind of like decade long mega cycle, like bull mega cycle in real estate, I don't see the catalyst for that returning like anywhere soon.
Yeah, Chris, what do you think?
Yeah, I think we'll be in a stall for a while, just overall. Law of averages kicking up, but kind of going back. I think long term, I think we'll see a big shift of people exiting properties. Combination again, not just the market, but they just want to be done with they want to kind of go more into retirement. And they got the trend here. It was a little over 12 years ago that the Jobs Act, kind of kickstarted all this stuff. The industry has matured a lot, right? Things have gotten better. More people are doing it. More people are becoming aware of it. And hey, I can get this alternative investment, still get into real estate, but be hands off, right? But they can still understand the deal and do all that. And so you get that trend going on there, which I think a lot of people will be shifting to.
Love that. Love that, man. Yeah, I mean, we never know what's going to happen. I mean, that real estate cycle that we just went through was super long, right? Super extended. I mean, they say there's usually like a 7-year cycle for real estate, and we went from, like I said, 2010 all the way up to 2021. Some would argue even like 2023. The interest rates, I think, started going up at like mid 2022, so that kind of ended it for us. But that was a really long run. Probably not going to see a run like that again, but I wouldn't be surprised if we see another 7-year cycle at some point.
Yeah.
I want to, jumping back on the trends from like an investing standpoint, I'm talking like residential real estate, right? Like multifamily, I think we've all heard this saying, survive till 25. Obviously that rhyming crystal ball not come true, right? It's going to take a couple more years for things to work out.
It usually works, unfortunately.
Yeah. The rhyme doesn't always, but there's been some amazing buying
Sounded
opportunities,
good
right?
at the time.
But the stress is in commercial assets, right? And this is stuff where like landlords like us on the here, like, hey, I'm not gonna go out there and buy that 200-unit apartment building. I'm not going there and buy that office building for 3 cents on the dollar. Like, I don't have know-how, but like the capital groups, the sponsors, bigger groups do. And so a big part of like, hey, residential real estate's just stalled. It's gonna be flat for a while. But like a lot of commercial assets, I mean, they are, there's buying opportunities coming up. I think it'll be more and more next couple of years. And the way you access those is through like, syndications, through passive investments. You're not going to go out there and I'm not going to 1031 into a 100-unit apartment building, right? Very, very few people do that. And it's just more momentum pushing over to like money is going to follow the deals. It's going to be in distressed commercial and it's going to be in like, lending to residential assets. Like that's where money is flowing.
Yeah, I know some people that are like killing it in the distressed note space right now. Like they did like 50% last year. And they're at like 30% year to date. I mean, that's like, I think, Chris, that was a very smart thing to point out. It's not like there's no opportunity at all. I mean, in fact, there's some amazing opportunities right now in multifamily.
There's always opportunity. It was always opportunities, and like one door closed, another door opens up. You have to rewire things, and that's been our thesis here. Is like, hey, Rich and I got in here. We wanted to invest in real estate, invest more into real estate, and we want to invest in the best deals we can ourselves, and then build the business around, creating that deal flow.
Totally. So is that what are you guys investing into right now personally? Like what, with your portfolios, with your access capital, kind of where are you placing it right now?
So I've been kind of the macro, two big things, I don't know, years ago or a few years ago, I started selling some rentals and going to passive. And then a few years before that, I kind of started converting some IRA retirement money, and just rather than buying new rentals, I started investing passively. So I've been kind of on this passive trend for a while, and I've invested a lot in multifamily, classic value add stuff, couple development deals recently, but a lot of debt as well, a lot of income. And what my plan going forward is to shift more of my portfolio from equity over towards cash flow and debt, for the cash flow reasons, and also just capital preservation. I'm at probably like 85-90% like equity and 10% debt funds right now, but I'm shifting a big chunk over to income and debt funds specifically, again for that cash flow and capital preservation. But that'll take a couple years to shift over. I got a lot of stuff has to sell, and not much is selling right now.
Well, and especially because you own like for example, your fourplex is a really great asset, and that's not something that you just like fire sale.
Oh yeah, absolutely not.
You should.
Pardon the interruption, but we don't do ads. Instead, know that if you're raising capital for real estate, my law firm, Raise Law, is here to give you the expert legal guidance you need to raise capital compliantly and structure and close your deal. And if you're looking for a done-for-you fund-to-fund solution, TribeVest is the industry's only all-in-one setup and fund administration solution. Visit raise.law and tribevest.com to learn more.
It's a really great asset. It's still performing really well. And so it's not like, the market's willing to give me this massive discount to sell it. No, just hold on to it. And that's, we have the same position. Like, be judicious about how you're disposing of these assets and making the transition. It's not like sell at all costs. I mean, I'm kind of in the same boat. Two of my rentals, I will absolutely be doing the same plan as Chris. It's just not the right time to sell. I mean, my rentals are in Colorado Springs, and we are one of those cities where we just had an enormous wave of supply, and like rents are way down, a lot of fear about insurance, prices are back up, and it's just not a good time to sell those assets. And, they're like, for the most part, wiping their face. And so, I will probably be transitioning those hopefully in the next few years, but the time isn't correct at the moment.
Awesome. Yeah, let's switch gears a little bit. We talked about it before, but, kind of that journey from passive to active or active to passive, whatever that journey looks like. I know you guys educate people on kind of going from passive, being a passive investor, to actually raising capital, right? that you already have and to aggregate some capital together. We call them independent capital aggregators, to raise capital. And instead of, let's say, you're in a typical, let's say syndication, there's a lot of different ways you can invest, but in a syndication, you're looking to double your money in 5 years, right? If you do that same investment where you're able to raise some capital and put your network together, you might be able to triple or quadruple your investment instead. Can you guys elaborate a little bit on that, what that looks like, and how you're seeing it as you educate the market on that journey?
Yeah, and I'll kind of start back at the origin, and we talked about like average return going active to passive on there, and then I built a high producing like investment brokerage team, and so I help hundreds of people buy rental properties, and as the numbers kind of stopped making sense in Colorado, hey, buying rentals just kind of stopped making sense. People said, hey, Chris, I know you're investing in these deals. I want to invest some as well. So some I'd recommend, but a lot I was like a friends and family, like a bigger group, or like they would take $1 million checks and they took my much smaller check, right? And so there are a few situations like that, and that's when kind of like the realization went off where, oh, hey, we've got great connections, we've done due diligence, we've got access. We can pull capital over here, get people into deals that they normally couldn't get into, and or better terms, and we got weight to carry in the deal. And so really started shifting, into structuring more deals, because win for the sponsor, win for us on the management side, and then kind of win for the investor. And so we did a lot of like equity law multifamily deals, but then Richard, you can talk about the transition on the operational standpoint, just kind of like the economics and the value of death behind the equity deals a lot of times.
Yeah. So, the double your money in 5 years, or the typical kind of, like value add cycle, when does all of that occur? Year 5, generally speaking, when you dispose of the asset. And, that's called like a J curve, which I'm sure Seth, but like the reason it's called a J curve is it's like basically flat, sometimes even goes negative, and then just a giant spike at the end, so it looks like a J on its side. And the problem is that if you are a sponsor, then your compensation on the deal via like carry, which is typically and should be the vast majority of your compensation, is when the project makes money and your LPs make money, you make money too. All of that occurs in year 5, and so that creates what's called like a cash flow conversion problem, which is generally the time in a business, that's an accounting term for the time when you make the sale versus like when you actually achieve the ROI on a cash basis. And so like that's clearly like a 5-year valley of death, as Chris said. And so but that was not like the sole reason why we shifted to credit. In fact, like the shift to credit was because it's what investors had demand for. But then we also happened to realize that because these funds were paying out either monthly or quarterly, our funds pay out monthly because also just our investors prefer a monthly check, and we're an investor-focused business. That means that we get to take our revenue monthly as well. And so because it's this very smooth, very consistent return, what that creates for us is like smooth recurring revenue. In fact, like we just hit $1 million in annual recurring carried interest from our funds like last month, and that every month we layer on like another, like I actually just got a text from my fund admin. I think we'll be doing another 3 million this month. And then so that'll add another 15,000 a month in recurring monthly income for us. I mean, and that's how you build a bit. Like businesses require like consistent revenue in order to like thrive and grow and be able to reinvest and everything like that. And it's just been, I mean, it's kind of obvious why it's better to be paid every single month than to wait for 5 years to get paid. But yeah.
Yeah, and let's dive into that a little deeper, right? So what we're talking about here is raising capital and trying to do it in a way that's somewhat passive. It's not passive, but maybe somebody's used to investing passively. They're used to giving an operator $50,000, $100,000, $500,000, and getting a return on that capital, and really sitting back and not doing anything. That's why it's called passive investing, right? But now there are avenues where you could potentially aggregate other people's capital together. A lot of people that we've seen have a lot of success with it are dentists, doctors, people that already have that built-in network of wealthy individuals around them, and they can say, hey, I'm investing in this deal. Do you guys want in? If you do, I can give you access, pool that money together, and then get paid on it. And because of technology, because of some of the companies out there, one that I'm involved with called TribeVest, all this stuff becomes a little bit more passive because you're not having to go out and having to put together a team, find a securities attorney, find a CPA that knows what they're doing, find an investor portal, managing your investors, managing your portfolio, doing your distributions, all those things that you got to put together that's a pain, especially for people that already have, let's say, a high demand W-2, like a doctor or a dentist or a lawyer. They don't have time to do it and they don't want to do it. Why would they? They already make enough money. But if they're able to do it easily, they can do that, right? If they have that network, they can do it. And if technology enables them to do it, then why not 3x or 4x your investment instead of 2x it? Where have you seen that work effectively in some of your students that you teach, right? And then I'd love for you to answer that, and then also go into what that actually looks like. Like, you guys are up to $1 million in MRR, but what's that look like maybe for somebody that's just getting started and maybe just pulling $500,000 or $1 million together?
Okay. So yeah, I'm glad you brought this up because this is kind of a new thing for us, is like developing our own network of fund-to-funds managers, or ICAs, Independent Capital Aggregators. I think the first thing you mentioned there was that you have to pre-qualify who these people are and whether or not they are equipped to succeed in this. And actually, I did work with Brittany at TribeVest to come up with this because I was talking about qualification earlier in terms of us saying, like, we're only trying to work with this type of person. And so, like, I know how important it is to make sure you're talking to the right person. And what we have found, well, originally I went as wide as possible. Like, we just blasted out an email saying, hey, do you want to learn how to raise capital? Come raise capital with me. And we had, like, program wide, I think like 1 out of 60 people succeeded, like actually managed to form a FOF. And it's because I went super wide. And I was just like, anybody can come. I ran a giant cohort. I said, this is going to be great. It's going to change your life. And only one guy worked out. And kind of after that, after 2 go-arounds of that, I went and talked to you guys, and I was like, I'm pretty sure that there's like, it's like really about the who. Like, and some people are vastly more likely to succeed than others. And then what we found out is, number one, you definitely, well, actually, the first thing isn't even the profession you're in. The first thing is, have you actively and passively invested before? This is absolutely crucial. And because you have to be able to make the explanation of, like, why not just buy a rental? Like, or why is investing passively a better fit, whether it's in this market or for your life goals? Number two, you have to have some concept of how these deals work, because even though TribeVest does a great job simplifying, these are still complicated securities, and funds that you are running at the end of the day, even though TribeVest like dramatically simplifies things, like, for sure. And then third of all, we found that someone who had some sort of entrepreneurial experience or is an executive is also much more likely to succeed. And what we also found out here was, like, successful real estate agents is another big category for us. And so taking all of that information, I went and, like, found one student who checked every single box. It was a husband and wife couple. Husband was an airline pilot. They make a ton of money. I don't know if anybody knows that, but airline pilots make a ton of money. The wife was a real estate agent, and both had I think that they had like 9 doors, and also had invested with us before LPs. And so all of that was like check, 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 check. I basically took them through the program. The program's pretty simple. We just give them a script for contacting basically everybody they know and then trying to start a conversation about it, because that is how you're going to raise your first $1 million, without a doubt. Like, you don't need to, like, go start a podcast. Like, you don't need to go do all these other things. If you have that built-in network, you're going to raise it from there. And that they just did, I got the text message yesterday, 1.1 million in their first month. And it, like, the playbook was not crazy. Like, none of this was crazy. I literally just had a script where it's like, you have 400 people, and you need to go tell 400 people that you are, like, doing this now. And that it was the exact script that you said, Seth, which is, I am investing in this deal. I have invested successfully in the past. I found a really great deal. We can get better terms if we invest together. Would you like to invest with me on this deal? It was that simple. I mean, there was nothing crazy at all. They just had to, like, work the system.
Well, I'll to a great explanation. I think there's another thing that you left out there to add on. I was like, you're right. You follow the system, right? You follow the system, but also they had a great product, right? It works for like you have to have a great product or a good product to sell, for people to invest in. And now something else we did is we leveraged some of the relationships we had, the funds, the structure, the knowledge, and like our whole playbook. And like, hey, here's everything. And so we kind of offered a huge shortcut on there, but that was part of like, hey, here's the know-how and here's a great product. And it was obviously one she believed in as well.
Yeah. In fairness, yes. So like we kind of told them the same thing, which was that we think debt funds is where it's at. And not just that, we think that there is an enormous gap in market knowledge on debt funds. I mean, as well as just like product awareness. Like everybody knows about real estate syndications. Far fewer people know about these private debt things. And then he kind of told me that the pilot husband was like, there's a couple other pilots out there that are famous capital raisers, And then he even came to me. He's like, I think I need to do self-storage deals. And I was like, I don't think you do. I mean, it is so much better just being like the debt guy pilot. I mean, that's another reason we've chosen to do it, is that there are just a million people out there selling multifamily and far fewer people out there selling private debt. And that enables us to dominate the conversation and not have like competing alternatives.
Love that. Tell us a little bit more about how you've done it. So the $1 million in recurring revenue, like that's incredible. How were you guys able to build that? Like where did it start and how were you able to grow it to where it is now?
I mean, this is where, it was years, almost a decade in the making, right? Like, Rich and I both had, marketing and business, background before getting into real estate. But I started the Denver Real Estate Investing Podcast in 2016 in Denver. And I'm up to like 600 now. And I did that because that was when I was getting 100% focused on buying rentals, locked in on starting, scaling up the brokerage business, all that. And I would just go out there and explore the market. So, we spent years, building another business, helping people do deals, and also just, doing what it takes. Being consistent with content, right? I think every single week for the last 7 or 8 years, we've always published a podcast, right? Have hosted local events all the time, teach classes, met with hundreds of people for beers and coffees and looking over spreadsheets. So there is just a lot of that long-term like sweat equity in there. And this kind of goes back to like we've been very focused on building brand, right? So people kind of have that name recognition. I want cash flow in real estate. I should talk to Chris. And building our community, right? Or our tribe. Building out like our community. And our community was, Denver and then, Colorado landlords, Colorado real estate investors. And so it was, years of that to understand like, we've got a much bigger network than most people. But it's that same thing. Everyone has a certain amount of relationships. We have them at scale. And then, we've gotten very, very intentional about how we actually can like launch our campaigns. And Richard, I know you talk about this a lot, so I'll let you go into it. But like, it's not just about launching the campaign, but it's about the branding and kind of like a whole sequence, Richard, to like go from like strategy to tactical.
Yeah. Okay. So, the thing about like getting into a new business is because obviously Chris had a lot of success selling brokerage, and then we had all the reasons to believe why we would just like launch out of the gate doing our own fund to funds and everything like that and be ultra successful. And then surprise, surprise, we like undershot our projections. We were supposed to raise $25 million in our first year, according to our pro forma. And then in our first 2 quarters combined, we raised like 2.5. And so we were like massive undershoot. And then kind of like the long story short there was like, it's a Hormoziism. I'm a big Alex Hormozi guy, is that like, you have to like suck at something long enough just to learn how to do it. And that, like, obviously you get all the self-doubt and you're like, oh, what if I just switch opportunities? What if we try this? What if we try this? What if we try this? And that kind of what it really came down to was we just had to, like, figure out what people want, number one. So it was just iterating on the product, and that's just experimentation and time. And number two, like, learn how to sell the thing. And I mean, that's like 1,000,002% optimizations kind of all added up. And so for us, what that process looks like is we kind of mapped all the areas of a deal that people usually have questions about in order to understand a deal. So number one, like, what is it? Number two, exactly who are you and why should we give you our money? Number three, like, exactly how does this financial model work to make money? Like, okay, it sounds right that, you know, these returns sound good, but like, explain to me the mechanics of how $1 of return is generated here. And, you know, whether that's your rent assumptions in a multifamily deal and like how rock solid are those, and like where are all the comps and all these things, or in a debt deal, it's like, show me how a given loan issued by this company produces $1 of return, you know, the origination components, the interest components, like if it's levered by a line of credit. Then we go into like a ton of all the risk management is step 4, because people's number one fear is losing money, and that far overpowers the greed, or like the difference between like 15 and 18%. It's all about like, how am I not going to lose money on this thing? And then kind of number 4, we just do the endless Q&A of just like, what about this? What about this? And so what that is we kind of like unmap like the cycle, the purchase psychological cycle that everybody goes through is generally those topics in that order, because it really goes from like high level to detail, and also down to like, okay, the greed gets them in the door. Okay, explain how this works. And then the fear kicks in. And so you have to build a logical case to like overcome the fear. And then it gets into just like the million Q&As that you just like have to answer kind of proactively, because the thing is that the vast majority of people, if they have a doubt or if they have a question, they're not going to ask. They're just going to like keep it in their head and decide not to buy. And so what we do is, like I said, just take everybody through that, through a series of emails, a series of webinars. We produce this giant deal room, like our deal room for our last fund, which we put, how much have we put in that? Like 19 million as of now, is probably, and I'm not exaggerating, like 7,000 words of text. And also like within that is like 4 or 5 hours of video, you know? And it's just because like, we don't want to repeat the conversation. We've heard every single question about this. We also know the general cycle of the points you have to hit, and then we just kind of automate that. And then we also send emails about all of those. And then we have a very simple automation. This is one of the highest ROI things we've ever done, where anyone who clicks a link in that email, our sales guy gets a task to call them the same day. And that is the system. Now, to me, it sounds like incredibly simple, especially because 3 years ago, I would have thought that I needed some crazy thing. But conceptually, I find it actually like pretty simple. You just have to be really disciplined and follow it.
Yeah, I mean, it sounds simple when you say it, but it's really hard to execute.
It's a lot of work. I think it's mostly just a lot of work.
Right. Everything you said, people were probably going, yeah, for sure. Yeah, totally agree. Like, yeah, I want to do that. I can do that. But it's about like consistency and execution is the hard part. It's easy to say, yes, I want to do these things, and yes, we should be doing these things, and yes, this will work. It will, but you've got to execute, and you've got to do it over and over and over again. Yeah. And you've got to iterate, you've got to perfect, you've got to relaunch, you've got to stick to it. You can't just give up and say, oh, well, now I don't want to raise capital for debt funds anymore because I'm not having the success I wanted or that I anticipated. So I'm going to go look at something else. And that's what most people do, whether that's raising capital or running a business or even in their careers with their jobs. They find something that they run up against the wall and they're like, all right, a little bit of resistance, I'm going to go a different direction because it must not be for me.
I mean, because the way that Hormozi explains that is like, you get on, something sounds really great from far away. Then you get a little closer, and I think a lawn is a good example. And then you're like, oh, there's some like dog poop in this lawn. Oh, that lawn over there looks a lot cleaner. But then as soon as you get over to that lawn, you got to realize it's got the same amount of dog poop. And what you really need to do is just like clean your lawn and figure out where everything is at. And that the phrase that we used was another Hormoziism: one product, one channel, $1 million a year in revenue. Like, just jam. Double down on what's working. Don't experiment with a bunch of new channels. And what I mean by channels is like, oh, I'm going to try Facebook ads this week, and then I'm going to try paid webinars the next week, and then I'm going to try a podcast tour. Like, find one thing. I mean, you got to do that experimentation at the beginning, but when you find one that seems like it's getting okay traction, like, just do that. Like, just do more of that and get better at it until you're at $1 million a year in revenue, and then you can start looking at diversification.
Yeah, and you also know exactly what you're talking about here. Like you know your deal, you know your industry, you know your clients. You know, you talked about, what happens to a single dollar. that gets invested, like that's incredible. Like just using that simple example saying, okay, you invest $1 with me. Here's what's going to happen to that dollar. 1 cent I'm going to take as a fee, right? The next 50 cents is going to go here. And then we're going to invest into this. It's going to kick back this. Like if you can walk an investor through a simple example like that, it's going to blow their minds, because if you guys talk to people out there like I do, I mean, out of all the folks out there raising capital, syndicating, doing deals, what percentage of them can actually do that? Very few. Very few.
We just spend time on it, like just obsessive focus and like totally understand it and just be an absolute perfectionist at your craft. Like that's it. There's no, and I'm saying that's it, as in that's really hard to do, but like that's just what it takes. Like
100%. All right, gentlemen, it's been awesome having you guys on. Where can our listeners find out more about you?
Well, I will drop 2 podcasts. If you want to know more about passive investing, go check out Passive Pockets, where I get to host the show there. And then Richard's now one of the hosts over at Best Ever CRE on the Unlimited Capital show. So looking at raising capital, check out Richard's show. More on the investing and LP side, listen to my show.
Yeah, that's why you ask Chris, what does the business do? You ask Chris. Like, you don't ask me, because I'm giving you like the big, So if you want technical mechanisms of raising capital, Unlimited Capital, every Monday on Best Ever CRE.
All right, gents. Appreciate your time. Thank you.
Bye, everyone.
Bye.
Thank you, Seth.
Thanks for tuning in to Raise the Bar Radio. If you enjoyed today's episode, make sure to subscribe, leave a review, and share it with someone who needs to hear it. Keep pushing, keep building, and keep raising the bar. Until next time, enjoy the journey.